morning, everyone. So for anyone that doesn't know me, I'm Julie Volker. I'm with Farm Credit Services of America as well. But I think today the panel, the idea was basically an open discussion for anything that anybody wants to know about loans, crop insurance, farm credit, what we do, who we are, anything like that as well. So basically anything you guys want to ask, these guys can answer it for you. And so I will let each of them introduce themselves, tell a little bit about their background, and their role at Farm Credit Services of America.
Ladies first. I'm Jess Shuler, and I'm an insurance officer with Farm Credit, and I'm up in the Powell office, and I've been in this role for a little over 2 years now. I was born and raised in Powell, so up in the basin. And I handle the crop insurance, so that's going to cover anything in the federal program for your row crops multi-peril coverage, as well as pasture, range, and forage, which you probably hear of as a rainfall policy covering your pasture, forage, and grazing grounds, and then also the livestock risk protection for your cattle operations.
I'm Robbie Alexander. I am from West Kentucky originally. People say they can recognize an accent pretty fast. I don't hear it. So I work with our young beginning farmers and ranchers, and we call it Developing Markets Program. I've been within 2 different farm credits for about 10 years now. And in my role, I try to focus on getting young and beginning farmers and ranchers started in the industry, along with help, some guidance as they work with FSA or other lenders, as we can team up to get them started, because it's not an easy task, even if you're starting from scratch or taking on a family operation. Try to work with them on a generational change as well. So I'm pretty busy some days. Mark?
I'm Mark Evans. I've only been with Farm Credit for about 10 months. Before that, been in banking for, 15 years about. So I was I grew up outside Pavilion, Wyoming, on a farm ranch operation. Then I was a commercial and ag loan officer for First Interstate for the whole 15 years, and then was the market president for First Interstate Bank. And been around ag lending. Like I said, grew up on farm and ranch operations, so familiar with crops and cattle operations and feedlots. And I cover, so I'm a market officer. I cover Northwest Wyoming, so Wind River Basin and the Bighorn Basin.
Alright, so with that, I think we'll just open it up. If you guys want to just ask questions, I've got some backup questions of kind of like commonly asked, but if you guys have anything you guys want to ask, go for it.
We can kind of start. I think one of the biggest things, especially that Robbie could probably speak to if you guys have questions on, is like getting young producers into it on capital needs and like programs offered. I don't know, Robbie.
Yeah, that's usually a great place to start. I will tell you, capital needs is definitely the biggest hurdle when it comes into getting people in agriculture. And we say young people as just a easy term to use, but I'll tell you, we are seeing an influx of people that are 40s and above, maybe retiring from fire departments, from the railroad, places like that, seeking ways to get into agriculture. So young people is starting to be a relative term, but there are vast interest in getting back to agriculture and getting back into the industry, and that's hopeful for a lot of us. It's been there for a while. But I will say, as you're doing that, the hardest part that I face is people aren't willing to get out and ask the questions. So even if you're looking at a family transition, a ranch transition, if you know somebody that's wanting to get into agriculture, don't have them wait until they have all the answers. Have them come in and give us a talk early. We don't charge anything to come in and talk to us. I mean, that's, you talk to a consultant, you talk to your feed guy, whatever, you start paying when you start buying stuff. We don't require that. We would much rather have those conversations 3, 4, 5 years in advance than wait till the 15 minutes because I just held my hand up at an auction and now I've got 30 days to close a land deal. That happens more time than not, and that's a horrible way for everybody to do business. We work well with FSA. I will tell you, I'm not an FSA person. I'm not a Farm Service Agency expert, But I feel like I spend more time talking about how to get loans through FSA than I do Farm Credit. And I'll add that in there, that it is a fantastic organization for what they offer. It is not an easy organization for what they offer. And I do not say that, I put it up, I personally have FSA loans, but it is sweat equity with a pen, plain and simple. A lot of us want to go out and buy that piece of property that we can build some equity in by putting up fences and things like that. Well, I'll tell you, with their loans right now, they've got a 50-50 program that caps out at $600,000, and their interest rate's 3.5% on a 40-year loan. Farm Credit can't beat that. We can't come close to matching that. So I'd much rather tell people what they need, where they can have their options, and work with them one-on-one through that than set them up for failure in the first place. So that's kind of what I do, where we're seeing young generations come in. The background on my role, we're a cooperative. The people that give us our rules, the people that tell us what to do, are customers of Farm Credit, and they're in the trenches. They're farmers and ranchers, and they say we need to find ways to get young people involved. I only carry about 50 customers at a time. That way I can work hand in hand with them. We have educational opportunities. I try to meet with them once or twice a year, depending on their needs and involvement in the program. Develop plans, stick with the plans. Sometimes I've even been known to go in and meet with mom, dad, and multiple generations at once, just to kind of talk about the plans and how to overcome challenges and those barriers of entry. I've said a lot. That was a good question. I'll be quiet now.
Well, I like to start, I guess I could tell everybody kind of what we're seeing is well, I can speak for Northwest Wyoming, Julie can speak for Southwest Wyoming as far as ag producers in Wyoming through our renewal cycle. We've been really blessed this year, honestly. I don't know how many people, the sugar beet market and around Northwest Wyoming, I think the plants averaged over 19% sugar averages, and the tonnages have just been incredible at 19% sugar. Coupled out with a strong sugar market, it's been a good year for sugar guys. And barley also, I don't hardly know, and I see Rowdy in the back, you might even know, there's hardly been any rejected barley that I know of.
No,
So,
we had a good year this year, not a lot of sprout.
yeah, so with that, the barley, so the cash crops have been incredibly strong between that. And beans were also strong this year, so pinto beans did well for that. So moving into next year, I think the sugar markets, everything I've heard there from the meetings, that there's no contract price that I know of yet, but it's assuming no deterioration, it's also gonna look pretty strong for next year. Pinto beans, we're gonna see a little drop. North Dakota came out with some pricing that wasn't appealing, but seed beans should be pretty strong coming into next year too. And then, of course, the cattle market, everybody knows where the cattle market's at, so the only risk that I've seen or nerves in the cattle market is there's been a transition, especially I know in Northwest Wyoming, a lot of cow-calf producers have transitioned more to yearling or grass cattle operations, and the price per head on the grass cattle right now is definitely putting stress on capital and requiring more capital to be borrowed. But from the year prior, like from the last time we saw really high prices in 14 when I was banking, we saw a bunch of outside capital come in, like bankers and attorneys and everybody else wanted to be in the cattle business. I haven't seen it personally through our loan request. We haven't seen that outside capital coming in, which makes this cattle market even a little more interesting for our area. Can't speak to anywhere else besides like Northwest Wyoming, but I just think with grass conditions could have some effect, as all the producers know. I mean, if we don't get spring moisture, we could be down. I haven't heard any AUM cuts or anything like that yet, but I think overall with cattle, sugar beets, barley, all of them hitting pretty well. It was a very good year, but then we went to a credit conference and heard that we're starting to see machinery and equipment levels. New machinery and equipment nationwide was down, pricing was down 17%. And I don't know if you ever need any equipment advice, Robbie again would know that, this better than me, but used equipment's starting to come down too a little bit, and I think a lot of that's driven by the corn and soybean market, so I bet specialized equipment for beet diggers and stuff around here seems to be holding value, in my opinion, more than, like I know big combines in Nebraska and stuff probably coming down, is where a lot of those numbers are being derived from on our map, but overall, everyone, right now it's a good time, and my advice is, it's a good time to build working capital levels and cash reserves, because all of us in the room that have been in agriculture for any amount of time know good times don't last forever, so it's probably there, and then land prices just continue to appreciate too, we keep seeing. I know ours showed 0% growth, when Farm Credit did a benchmark growth, so 0% increase year over year, but still when you're between 4,000 and 6,500 an acre for purchase price, it takes a lot to pencil that still for capital for growth, so.
And I'd add to that, we haven't seen the expansion of land prices out here other states have, but a lot of it is due, in my opinion, because we just don't have the inventory moving that other states have had over the past couple of years. So that kind of holds down the benchmarks and keep it stagnant. But that doesn't say that if you go out and try to buy a place right now, it's going to be the same price it was at the beginning of last year.
And the other tricky thing is Wyoming's a non-disclosure state too, so we have a hard time getting sales versus some of the other
Actual
states.
numbers,
Yeah. So it's not public sales.
Jess, I know, since you talked about cattle prices, do you want to talk about
Risk mitigation?
livestock risk mitigation? Yeah, kind of what you're seeing on that side of it?
Yeah, I was kind of thinking to the other side, you're talking about that it was a strong year and we saw good results with crops and with the cattle market. But kind of looking at my side is to look at that risk mitigation and, when it comes to the multi-peril and covering your crops, we've got such a variety of options we can even take on that. But looking at like your prices and the costs of things coming into this year, we need to look at that strategy a little bit different too, of your underlying coverages, but then we can also look at from a county, there's a lot of area plans that we can also supplement to that, where you can take advantage of getting payments through that type of program as well to cover yourself on top. So it's a little bit more like, instead of setting your coverage that you have underlying, you can then capture up to almost a 95% coverage just to make sure that you're able to capture and regain some of that price back that we may see in drop this year. So there's a way to kind of look at that risk on your row crops as well. And then, speaking to the cattle part of it, there's kind of two ways that we're looking at that. I would like to talk about the pasture range and forage, because that's a way where we're talking about lack of grass and the precipitation and that concern. That program is excellent for being able to look at any of your pasture, your forage, and we can look at your haying ground, whether it's irrigated or non-irrigated, as well as any of your grazing allotments or ground that you have, and it's going to look at the rainfall, so any precipitation that's landing on there. And when we have the lack thereof, there's a system I can put your grid into, so the whole United States is split up into 17 by 17 mile grids. And wherever your land lays in that, I can pull up that grid and get 30 years of historical data that's going to explain the lack thereof, the precipitation. And basically then we choose 2 intervals or 2 months throughout the whole year, or they go in 2-month intervals, and we have to choose at least 2 of those to cover you in. But looking at your operation and where's the lack thereof based on the data, but also when do you need it most. And we can set that up to cover you. And essentially in that, if that falls below the expected rainfall, then there's a payment to you. And that can help cover where we're not seeing the grass that we need. So that's one piece of it. And then if we look at the livestock risk protection, that's setting your market price. So looking specifically at what is the price in the market doing. So it's market coverage. It's not going to matter what you sell for in a local market. It's setting it off of the Chicago Mercantile. So it's setting it off the board. And then you set that expected price within an endorsement date. Wherever you're going to market and sell, we want to get as close to your sell date. So if we're looking at the fall, we look at September. If that's when you're selling, you have a 60-day window prior to, so you can kind of set that where you need to based on the price you'd like. And then when we lock you in, that's going to settle off of the feeder cattle index. So you've got a little bit less volatility in that 7-day rolling average, but also that's gonna factor in some of your local sales, because that's what's feeding into the index. And it's also proven to be favorable for this area over maybe even some of the other areas, because we're getting some of those southern prices that kind of pull that down a little bit too. But it's a way to set a floor for you. So we're not taking away a ceiling. You can still capture some of those really good prices that we're seeing in the local barns and sales or on even video auctions. And the video auctions don't end up in that feeder cattle index. So some of those higher prices that we see on there aren't necessarily driving that away from you. But you can essentially, by locking in, set your floor and know that you can pencil that and have that expectation. Because then if, when it comes to your endorsement end date, it's gonna be specific on that date you might have already sold. You'll turn in your sales receipt as proof of ownership. But then if that price on the market of the day of your end date is less than what you locked in for, then you're due an indemnity to try to make it whole for you. So there's really a way to just set that floor for you and still allow that ceiling, and that you're not setting a ceiling on yourself, that you can still go big on that. And then you can also utilize then, we don't handle them because we're not in the brokerage part of it yet, but you can still utilize your puts, calls, options, and things as well in addition to that. But that program has grown a lot in the idea that they changed a few things about it. Before you used to have to pay that premium up front. Now you pay your premium at the end when you've already sold, you have the cash. So you, and then if you're having an indemnity come due to you, you know, you've got that money in hand too to kind of counteract that premium. It is a subsidized program, and so you do have a lower premium rate on that too. And that program runs with, instead of running with the calendar, the year will end in July. So there is some changes that are gonna be up and coming. So July 1 will start actually crop year for 2026 on the cattle side for that. But when that switches over, we'll have some changes upcoming to the program that they've been talking about. And right now, one of those is a subsidy change. So typically, your middle, like 20, 30 week endorsement dates that are kind of putting you out a little ways, those are gonna be your best subsidized. So they're gonna give you the best bang for your buck as far as what you can afford on premium. And then the shorter ones are even less. But to try to help set it up so that you can plan long-term for your risk mitigation, they're looking at swapping that to give the better subsidized option to those longer endorsement dates, so that you can plan almost that 52 weeks out and get a better premium on it. Which I'm hoping that that's one that we'll see come through with the year change. But they're constantly evolving these programs, and that's something that I really enjoy. Farm Credit puts a lot of emphasis in, you know, I'm an insurance officer, so that's strictly all that I do. And so we're able to do the extra education and dig into all of the programs and get the information ahead of time so that we fully can digest it and be able to present it to you guys in the best way that's gonna help your operation.
Question?
So I gotta ask you, have you ever had much notice for a whole farm?
We have had whole farm policies. Typically, the ones that we've had, we've moved away from because we were able to, for essentially the same cost, give a better coverage. That may not be the case in every situation, but when you're looking at the whole farm, you can lose a lot on some of your revenue because, you know, if you've got cattle or sheep, or if you've got your row crops, something can outperform and take you out of a loss in any of those situations. It's all one pot. If we can take that and separate it out and still make it affordable to you, we're giving you better coverage to kind of itemize that out in the different coverages.
So what about micro farm? Anybody? Yeah.
I have not done anything with the micro farms personally yet, so.
So probably potentially have people that might be interested at that kind of a level. I don't know, they're pushing it, and I'm sad on some things, so I was kind of curious if you guys have seen any traffic on that.
I haven't on the insurance side, but it's definitely something that, yeah, I mean, we can always look at the scenario and see what best fits and what I'm able to do from the federal coverage side. So a lot of the time with that, you know, each county has, and I cover the whole state of Wyoming, except for Laramie and Goshen County, and then I do help with western South Dakota, because from an insurance side, my region covers my leaders in South Dakota, so kind of a different region. But for the state, each of the counties kind of has different rules on what you can cover and how you can cover it, and a lot of the times we can go to RMA, which is, the, government side of the crop insurance program. We can go to them with requests on certain things as well, if it's not just listed immediately available to us. So it's always something that I, say if I don't know about it, I can certainly dig into it and get more information, so.
Well, particularly for people that are getting started,
Yeah,
it could potentially make the difference, particularly over some challenging years, even a short period of, say, 3 years, it can make the difference between staying in and, being out.
absolutely.
But if you're in it at a scale, it's not, those programs aren't necessarily the best way. But it tends to allow for coverage of stuff that fit, that maybe would get missed in the middle, so to speak. In a lot of cases, the dedicated policy is a better option, it seems like, so that, thank you.
Yeah.
Other questions?
We'll go into some of the common ones, I guess. So can you guys share a little bit on the loan side, a little bit about the difference between a consumer real estate or home loan versus ag real estate loans?
Yes. Mark?
Well, typically, like, for consumer, like, the way we look at that is, now I got my head going, but, so if you're if you wanted to get a consumer real estate loan, we have a product called Rural First, which, technically would be a lot like what they call at a bank, a secondary market mortgage. So that's a 30-year fixed rate, 15-year fixed rate loan. A lot of those loans at local banks are not held by the bank, just so everybody knows. And what they do with those mortgages is you fit a box. So if you, typically what they're designed for is somebody working W-2 job or very simple self-employment. Like I can think of like a plumber, electrician, somebody who's got a QuickBooks statement that they can pull 2 years of revenue and come up with a wage income, and then what they do is they just take your gross monthly income and slap it against and figure out a debt to income ratio, whether or not you can afford that house. And then there's a little more factors than that, but that's overwhelming, so it fits that box really well. And what the bank does then is takes that mortgage once it's signed and they sell that off to what we call the secondary market. And then the bank still services that loan, but they don't own that loan anymore. Ag real estate loans through banking or farm credit are a little bit different. Banks own those loans and they're offset by the cost of funds that the bank has. So banks collect their money from deposits, where farm credit collects their money from the US Treasury or agribank, but there's an offsetting funding source on those types of loans for an ag real estate loan. So they are not sold to insurance companies or what we call the secondary market. They're all held there. Farm Credit sells them off to issues to bondholders through agribank is the company we use to do that. So the funding source is set there, and then what you do on Farm Credit side is they'll get investors to buy the bonds. Farm Credit then is the servicer of those. Typical bank holds that loan as an asset and then have a spread to the deposit to get the price. So what we've seen in the last little bit is an increase in what people are wanting paid for deposits due to the Treasury rate increase, because the U.S. Treasury rates have continued to increase. So that's caused an increase in interest rates on both the bond side and the bank side. So that's why we have the increase in rates. But typically on the ag side, where I was going, when you come to apply for an ag loan, what we, like Robbie, myself, and Julie would look at is the production value on that ground and what's the highest and best use of the ground. So the highest and best use of the ground would be cash crop or cattle grazing. More complicated properties, those would be considered an ag loan. Usually over 80 acres is usually the cut, 40 to 80 acres depending on what loan you're looking at. Anything above that would fall into an ag loan category typically. But then we're gonna look at the repayment of that property, whether it be for farm credit, we could do investor loans, so people that are buying ag real estate to get a lease repayment source out of it. Or we would look at it as a growth in production for cattle. So that's the two different types. So the ag loan side of it is mainly you're buying the ag real estate to get a return of some type out of it, where a consumer loan is you're buying it as a fixed asset for a place to live as a personal residence.
And that changes how we work with people. I have people call quite a bit and say, hey, I want to get pre-approved for a loan. Well, if you get pre-approved for a house, I will tell you, a quick pre-approval doesn't mean a whole lot, other than they just know about how much money you're gonna make. They haven't dug into it, so if you got a pre-approval, that doesn't equal a loan approval on a lot of the housing market. But going back from that, if you want a pre-approval for a loan in the farm world, it's a lot more complicated, because a lot of times, you're buying an asset that is income generating. Well, the income that's being generated is gonna change how the rest of that loan looks, so. And I think there's so much information put out about, go get a pre-approval, go back and you can do this, and you only need 10% down, or you only need 15% down. Well, realize that is a lot of consumer loan information, and that doesn't necessarily apply in the ag world. And that's probably the biggest misconception I see when we talk about consumer loans compared to ag loans. I have people regularly, especially in my line of work where I work with young and beginning farming ranchers, if their first generation and the most mom and dad ever purchased was a house and they've never been in the farm side, they come in with some preconceived notions. And they're like, well, I've got 15% down. And I'm like, we're still pretty far off. Once again, I start talking to them about FSA, which may or may not work if they don't have a Schedule F filed on their taxes. The other part to that is, a house is not an income generating revenue source. So it changes the entire picture. And that's one place I would always say we need to do our homework. Let's start long in advance on having those conversations.
Well, and I don't mean anything against consumer lenders, but a lot of that's plug and chug as far as you giving a hard number and then you can calculate into a ratio really easily. On the ag lending side, we do, everybody in here is probably involved in agriculture degree, so you guys all know what tax returns look like for most farmers and ranchers, is it doesn't always show the whole picture. So what we do as ag lenders is we track balance sheet, or we call it an earned net worth gain. So we hold a constant level value on everything, and we see how much your net worth has improved year over year, and then we calculate that based on repayment of the loan. So it's a lot. If you're not an ag lender, it's a different view of it, and it's really good for everybody in this room to understand how we look at an earned net worth gain, because that's what I think, I don't know, every ag lender, probably any ag lender will trend an earned net worth gain. And so I believe FSA does this too. We've got Brian in here so he could tell, but they're gonna track they'll track the one balance sheet period to the next, holding all the values constant so you get a true value of your earnings. And then what you can do is figure out from that on how much, holding all the cattle and everything, breeding cattle and machinery and equipment constant, real estate constant, you can get a true picture of what the operation earned year over year. So from that point, then you can figure out what the debt service is. And then bankers always love projections too, because it'll show us an idea of what versus the producers in the area where your cost expense ratios are year over year, and to see if that, because you can take a projection and versus the earned net worth gain you've had for the previous couple of years, and you can calculate into whether or not the projection's accurate or not with the changes in the cattle market or cash grain markets. You can kind of help and counsel that way so that you can really get an idea where it is. So it's not, consumer lending's kind of, like I said, it fits in a bucket. Ag lending takes a little more analysis and paperwork to get there. So that's why we always ask for a lot of paperwork. It's more of an art.
Well, so now you touched on it, so if somebody was going in to get a loan, what typically do they need to do an ag loan? Financials wise.
Blood
Don't worry
samples,
about it.
firstborn child. A little bit of everything. Honestly, there's a standard answer there. 3 years tax returns is a great place to start. Balance sheet with true and accurate information. Cash flow projection, and the more years you have that, the better off you're going to be. I compare finances a lot. Let's look at the cow-calf operation. You got a heifer calf, and or a heifer cow, she's fixing to have her first calf. you have an idea what that calf would look like based on what the bull looks like, what she's done, but you don't know until you have the first one. You get 5 years of calves out of that old girl, you kind of know what's coming out. Finances are a lot the same way. We do that first loan, we've got to make some projections, we've got to make some predictions if you don't have those answers. The more information you can tell us, the better. And then 5 years down, we can start making some real good choices. But I would also keep going back. If you give us junk answers, you're going to get junk results. And a good no is always better than a bad yes when it comes to a loan. So I would always say when you're coming in, if you can come in with 3 years tax returns, if you can come in with that balance sheet, and you can come in with that cash flow projection and multiple years of each, that's a great place to get started.
So Robbie, I gotta ask you, I may have asked you this before, but I'm gonna ask you now.
I like that you're here now.
You very generously offered to sit with people, and I know that that's part of what you're doing, particularly with new and beginning folks that maybe don't have these projections and so on. I'm curious if you will, if the FSA route actually looks like a better option or could be worked into the overall picture that somebody might reasonably pull together as the package. Are you able and willing to sit with them to navigate the other side and sort of the generalities at least, and then work that through to some kind of a general overview of what kind of picture they would be facing? You hear what I'm saying? It's
Mhm.
really more like kind of financial counseling in some ways, but are you able to go that far with them, or would they need to work with FSA on that part, and then you would do your part, and then they kind of have to put it together themselves?
I would honestly prefer to do that. Now, and I'll tell anybody, I'm not an FSA employee, I'm not an FSA expert. My FSA knowledge is based on me being an FSA customer. And there's a lot of rules and regulations over there that are ever evolving. I'm not gonna pretend to say, if you go here and do this, and say, the guy from Farm Credit said this is gonna work. So I never pretend to do that, but absolutely, because the ultimate plan, and I think anybody from FSA will agree with, is not, FSA ain't a long-term lender. I would much rather work with them, and get a plan and say, hey, do this for 3 or 4 years and let's reevaluate and get you back over here. Let's let you earn some of that pencil equity for a few years and build some of that up. And if we can all know that plan, then we're all in a better situation. As far as the counseling, absolutely. I'm willing to look through and go through all of it. But I will always advocate there will be more questions. It will not be cut and dry.
And I don't want to make FSA sound like they're bad guys. I know they're nice people too, but my perception is their hands are tied a little bit further than you guys have. A little more flexibility that way, so I'm just curious if you can go down that road, particularly if somebody doesn't have that background,
Absolutely.
We in extension help people with some of that kind of stuff too, but you're doing it with a little more authority, particularly when you're able to authorize or help them, coach them into getting the right path figured out early on.
Well,
Thank you.
Yeah, glad.
just my experience, the last thing the worst thing we could do is lend somebody money with too much money in a position where they can't. So people get excited in the beginning, and then once they're in it a year or two, they realize that leverage can be a kiss of death in an operation. So it's one of those things you gotta be really, when you go into those FSA programs, in my experience, you have to be really, really cognizant of what you're getting yourself into to make sure your projections are solid. So I think that's what FSA does a really good job of vetting those to make sure that they're not setting somebody up to fail essentially. Because nobody wants to watch somebody fail. That's my 2 cents on it.
And this is, I say this lightly, I don't have any loans going with anybody in here right now. But when I have a young producer, and that's what I mainly work with, and they walk in and they say, I don't want to deal with FSA, it's too much work. What do you think agriculture is? It's a lot of work. That's usually my first sign that I'm not sure.
What you're doing.
I was, my job with young producers is to help find people we want to stick our neck for. Julie, Mark can all make loans to young producers. My program is designed to stick our neck out a little bit more. Well, if they're not willing to put in the work and come in with that solid business plan, solid time set into it, that my first job is to protect the cooperative so that we can lend to agriculture as a whole. So that's usually a sign of intent on a young producer if they're willing to do that.
Yeah, and the other thing about it is we've talked before, and I was talking to somebody yesterday, so as you make that comment, it comes to mind, but this guy made the comment to me that, we don't, as the older generation, don't figure out how to help and create pathways for people to come on board. How's it ever gonna work? It's just not going to work.
Absolutely.
It's to the point now where it cannot work. So these programs like you're able to offer, and certainly FSA offers, and there are some other things that can help. The insurance programs are incentivized to help bring new people into the fold as well. But if those programs aren't there, then it's not possible to go into agriculture unless you just straight up inherit it. And a lot of those cases aren't very good workouts either, because people haven't been mentored into having the skills to manage it at level that would require. So there's, that's I guess part of what I've been busy doing, is trying to create this internship thing where people are getting a little bit of experience. But we all need to be kind of working together as a team in our industry to help that all happen as smoothly and as well as it can be for the success of the industry as well as the individuals.
Well, and part of the thing, even in multi-generational things, Mark, we've talked about this some. Right now, so when you go in and you're looking at these things as income generating assets, which is what they should be, but you still have the reality of what the value of that is, and trying to work out what a rental needs to be on what the value is now is so out of kilter and very tough. And you talk about the inheritance, but of all the multi-generational things I know, nobody got given anything. You have to take care of that generation that's ahead somewhere. I mean, that's their retirement and that's their thing. So most people come in maybe at death or something that way, but it's got to come in through leases or something. Somehow that generation ahead has to be able to live off of and retire and everything off of what they have. So it's not just this gift that comes from nowhere.
And I'll tell you, as I work with younger folks, I gotta be careful how I say this, y'all running me out of the room now in the States. There's a lot of truth. Nobody has been given anything. And I'll bring up some of these conversations, and I have a lot of people say, but back when I got started, real estate, interest loans were 14%. It was harder then. I will make the argument now, even though we have to take care of multiple generations, if you look at land values in the past 5 years have doubled in 5 years. So we've reached a time though where that same piece of property, it honestly may not be feasible to take care of 2 generations.
Exactly.
And I think we're losing sight of the fact in transitions a lot of time how much the transitions cost. And we've got 2 trains of thoughts out there. We've got the transition thought of, I gotta be fair to everybody, and we're giving up so much equity that the next generation can't take it over. And then we're living with the train of thought of, I'm just not worried about it, they'll figure it out. I am a believer, I'm careful how I say this, our biggest threat in prices right now, our biggest threat in tariffs, our biggest threat in interest rates, it is ourselves and a generational alignment on agriculture. And if we don't start having hard, serious conversations, and I will tell you that have peers that are of less hair than I have, and that's not very much. If we don't start pushing each other to do that, we're going to kill our own industry as agriculturalists, because it is trouble right now. Now I'm doom and gloom. I don't like me at all.
I was gonna pick on that too, because the other expense that I think every banker's always gotten a disagreement with is cost of living too.
Yeah.
We have to look at that too with just the economy and everything. Cost of living expenses when we go back and look at it, they have increased substantially. So when your cost of living expense increases X%, and then you have your gross revenue that only expands so much, it limits the amount of people that can be on the farm, right? So it does, and no one wants to kick a kid off the farm, right? That's not a goal, but I mean, it's one of those things that it needs to be looked at and openly discussed on what our asset can revenue production do versus on the increased cost of living. So it's one of those things that it's a hard discussion to have, and it's one of those things, but it does continue to increase. I mean, health insurance premiums are extremely high. There's just cost of living expenses, and you can live as frugally as you can, but still those costs have increased, I'd say over the last 5 years substantially for what I've seen. So it's just one of those things that continues to increase without outside income coming in to support a family on an ag operation. So it's another factor that's causing some of these different generational, and I think it has to deal with the cost of living on some of these transitional discussions too. So you don't want to starve somebody.
Don't bail me out maybe a little bit. You know, I wouldn't disagree with what you said. I can be kind of glued to an economist after all, so that kind of comes to my nature. But I would argue with you a little bit. If you look back even just a few years, you know, agriculture is a pretty resilient industry. You certainly could go back to the Dust Bowl and some of the other challenging times that we aren't quite facing yet. But what I would argue that's the challenge for us today, in many ways, is our level of expectation, because we've done so well in recent decades, right? We have really, as an industry, done quite well, although there have been obviously quite a few road bumps along the way. But when we're challenged, when a push comes to shove, well, we're going to step up, and we all know that. It's the core of what makes us Americans in many ways, especially us that are involved in agriculture feel that. But we're hoping we don't have to go there, and I think we hit it. You know, it's that business of communicating about it, where I don't know. Again, it's expectation also creates opportunities in our society in general. There's a lot of other things young people can do that pay better, or they actually are nicer, or more accommodating in terms of weekends off, or however you want to phrase that. That are alternative forms of employment that we qualify for. And so keeping the kids on the farm becomes the challenge. And I don't know that there's an answer to that, but if we can recognize what's going on, that we're at least a little bit closer to finding a solution that might work going forward. I think we do have to embrace it somehow.
And I think
the last thing we want to talk about is our family problems, and many times that's exactly what we're facing, is that we have challenges communicating with each other, or there have been things that have come up, and so we just don't want to go there, and well, that helps keep things going the way they are, and then that leads to the separation, which of course is what we want to avoid.
And I think that's the crutch that I see a lot, is you have a mature producer who has a certain amount of assets and their leverage level's low, and they want to keep the kids on the farm. But in order to keep the kids on the farm, you need more revenue and more of that. So it would involve taking more risk on and expanding, because we're seeing a lot of, I guess you'd call it consolidation, but growth to support more families. And I think that's where agriculture's headed, is if you're not growing, you're reducing down the revenue. Because
I'm going to back you up on a comment you just made. It had never really struck me like that. But you said cost of living.
Yeah.
I mean, we could lower our standard. That's another possibility.
We could.
Choice for us.
Yeah.
Right? But that's maybe part of the problem, is we've reached this level that I was describing as being successful, right? We've reached this level where we don't want to go back.
Right.
As the retiring generation. After all, we earned where we're at, doggone it. And so that's where the giving up thing, I think Vince is kind of addressing a little bit earlier, is, we kind of feel that pull and the tug and the challenge of it, and we don't want to go backwards. So as you describe it, we tend to think of it as, well, we need to get some more revenue, we need better help with, insurance products or some other kind of way to make this better going forward for everybody. And that may not be the best, or very likely anyway. Certainly would be best, we could get that to work, but it may not be very likely.
Well, I think we've got competitive pressure coming in both ways. I mean, there's big money out there that are driving up land values that get the rentals out of kilter. So you've got that going on. And then we've got a limited amount of these kids, and I hate to be too general, but quite frankly, you look around our society and our nation anymore, we got the most talented people. So anyone in other industries are trying to get ag kids. I know clear back at UW, Walmart's head guy was coming in, they wouldn't recruit for management in any business colleges, only the ag colleges. And I mean, so that's a thing that's been known for quite some time, so you're fighting with that increased cost, you know, everybody, oh, you got this land that's worth so much, well, that's an input for us. And then at the same time, there's big competition for your kids too. So it's a double-edged sword.
On a happier note, though, I will say this, for young generations coming in, as we can be doom and gloom, we're at an exciting time, but we're gonna have to take some judgment about it. Direct-to-consumer beef, is it hard? Absolutely. But is there an opportunity there? Absolutely. I mean, we're gonna have to continue to build and find ways. I mean, we might have to, I'll use the beef industry, we might have to come together and hire somebody to sell Wyoming beef in 5-star Michelin restaurants in New York and just be our representative. There's so many options out there right now. I will say, if you've got a young person on the ranch and they break out their phone and start recording what they're doing because they're recording TikToks, don't pass too much judgment when people are getting $30, $40, $50, $100,000 checks because they're selling TikTok videos. We have to think about stuff different. And we laugh at that, but I know a guy right now that I think he's getting about $30,000 a year from TikTok. And they are the dumbest videos I've ever seen. I mean, it is, the Three Stooges gives you more intellectual content than this guy. But he's subsidizing a pretty good living off of doing it. So there's tons of things out there, and the world is desperate to learn about what we do. I mean, coming from Kentucky, we have the Bourbon Trail. I'm a big believer here in Wyoming, and y'all are stuck with me now. I'm like your heritage biscuit. I'm not going anywhere. That we need a beef tour. We need stuff. People want to be cowboys. Let's give them an experience, and we're all going to have to work together to do that. But that's how we're going to transition forward. And I'll go back and say, traditionally, if we look at just taking cattle to the market, I mean, what is that, 2 or 3 generations at most? Before that, this is what they did. They sold directly to the army. They sold directly to in town. It's really going back to our roots a little bit. It's not what we've always done. There is tons of opportunity out there. So I would say, when you got somebody else coming back to the ranch, to the farm, whatever, be sure they have a plan. Even if they're coming back and you think they know everything, ask them what their plan is to make their own salary. And if it's not there, say, well, maybe go work in town for a few more years. So that's an opinion. Maybe right, maybe wrong, but it is a call.
Very valid.
I think that basically ends the time, and they're ready to kick us out, so. If
Stop
there's
us with
anything
any
else,
questions.
please ask us, stop any one of us, ask us individually or whatever.